TGIF, everybody. How's everyone doing? Hope everyone had a good week. Tom Stapleford, welcome to F.A.C.E. Angela Serino, welcome to F.A.C.E. Hiya, Mary, Richard, everybody. Sinatra, Richard, Ryan, how are you, buddy?
Bit rough. How are you, mate?
Pretty rough.
It'll be rough together.
See. Okay, so can you see the screen, Ryan?
I can see the Forex Analytix funding program
Okay,
page.
so all right.
Hit it with a hammer.
Yeah, I was using a surgical tool. Now we have it, right?
Nope.
Huh. New share. Resume share.
There we go.
Now? Okay.
Yeah, there we go.
All right. So a little recovery in FX today. Pullback in yen. What are you guys doing here? You think this is important or just another pause to refresh before another move to the upside?
I think we may see a similar series of price action that we saw when we got up to 129. Okay. we had a bit of a top. We came off a bit, then we sort of went 127, 129. Yeah. I think we maybe moved up a stage and are going to see a similar pattern emerge.
Okay.
So that 129, that prior top around 129 is going to need watching because that's likely to be our main support point in this phase anyway.
Yeah, that's a great point. Prior highs, this area. Yeah.
Yeah.
Okay. Man, is he around?
Yes, I am. Good morning, Dale. Good morning.
Good morning. Same thoughts as Ryan?
I'm just watching the clock for the fixings. I think a lot of it is end of month still, especially today in yen, last day. But I'd assume that the natural way of things would be to find demand if we get back closer to 129, 129 and a quarter, perhaps. Or already 129 and a half, but I'm not doing anything here. I showed in the room yesterday a bit of a possible target around the 130, 140, 45 in the dollar yen. We fell just short of that. But okay, I mean, it's not going to be a one-way street, I think, from here.
Okay.
But then if we see a decent drop with what the Bank of Japan said, taking into account that we have Golden Week in Japan and in China for that matter, I do think that we still find bids on dips in yen pairs, perhaps especially dollar yen going into the FOMC after what the BOJ did.
Okay. Yeah, definitely momentum's waning, but even waning momentum in the yen on a daily is still almost 80.
Yeah.
So, you know what I mean? So it's still a lot.
We're going to be without Japan next week.
We had the same thing when we hit 125, right? A very sharp move back down to 121 and a half, and then
then the big move here, and then the big move here. But I don't take divergent signals unless we're under 70 after, a couple of lower momentum peaks. But Ryan, Aussie came right back with any dollar weakness coming back stronger than anything.
Yeah, just quickly before that, Dale.
Okay.
Is Japan off all week next week, or is it like only 4 days or something?
I think Monday they may be open on Monday. But then it's pretty much the rest of the week off.
Because that's obviously going to be over the FOMC, so it could be a bit.
I think they're off on FOMC, yes.
Yeah.
Just a couple things I was talking about in the stock market, and I know, my natural bias is to be bearish, okay? But, when I had this wedge drawn here on the semis, and they're the most hated, I know the market's going to come in lower. But there are some semis that are actually putting in reversal weeks. I guess you could say the same line held in S&Ps as well. And I'm thinking if these lows hold, especially after the Fed, that there could be an upside surprise because, when I look at, say, for example, the semis, and everyone hates them now, right? I mean, they went from the most loved to the most hated. Does that look that bearish to you?
Looks bearish enough. The trend is the trend, as you say.
All right.
It's trending up anymore.
Yeah, kind of looks like a consolidation formation to me. Where. Yeah. Anyway, I'm just saying, with everything that the market has thrown, everything that's been thrown at this market, and all the bearishness, I don't know. It doesn't look that bearish. If we take out this week's lows, that opens it up. But I think everyone's on one side of the ship here now.
Yeah,
and,
probably.
we haven't seen it for decades where you really have this many bears around. So just food for thought. And
so how do we consolidate stocks with the GDP yesterday? Because although I was on the trade, it came out awful. And
it was.
Well, how do you consolidate stocks when Amazon just cracked? Pre-market. I mean, we just cracked lows that we haven't seen since 2020. I mean, I don't know.
Amazon's a big part of the NASDAQ, so NASDAQ's down 37 right now. We'll see. I'm just saying there are a lot of bears, and guys like David, the bulls are really being ridiculed. Of course, Kathy Wood is being definitely, she's like the poster child for this correction.
She's being hung out to dry right now. So
yeah. But it's easier to be bearish.
I don't go for 10 minutes without seeing a tweet with her name in it. It's crazy.
Yeah.
So good morning, guys. By the way,
good morning, Blake.
TGIF. Ryan, welcome back. Sorry about West Ham. I thought it was completely over, but I guess you guys still have another game.
Yeah, that's right. I'll be heading off to Germany next week to see if we can pull a miracle like we did in France.
Wow. That
are you getting much playing time, Ryan, at these games?
You wouldn't like to see me play at this age, Dale.
Maybe a substitute as the ball.
Yeah, I don't know. I'll be in the bar. That's my position. That's my best position.
Well, anyway. I was just going to say, the Phoenix Suns, they closed out their series last night, which I was pretty happy about. I wasn't sure if they were going to be able to do it. So I'm kind of on the bandwagon with my local team here as well.
Cool.
So for the NBA, it's
grassroots.
It's fun. But let's talk markets as we got about 20 minutes before we got producer prices today. Really important data coming out today. Or was it producer prices or wait a second?
PCE.
PCE. I'm sorry. Friday slippage. It's PCE. It's month end. In our chat room, and this is interesting. I want to talk about this for a second because James he put out a message earlier, and he's been a great addition to our chat room. He's been somebody that came from your community, Ryan and K-Man, and now he's in our community as well. He was sharing that, end of month flows, Goldman says that there's going to be some dollar selling, right? And so when did he put out that message? It was earlier this morning, I'm assuming, right?
Mm-hmm.
Yeah. And so what we've seen some dollar selling, as that's come out. But there's something that I wanted to say really quick. Just trading with the guys that I trade, knowing who they know, getting information that they've gotten, and the guys that I have traded with over the years, when I was doing proprietary trading, about for that 5-year time span, I got a lot of information from a lot of traders, and you guys will be able to chime into this as well. But a lot of people, a lot of the guys that I know and I still communicate with, when they get information from Goldman, it is what Goldman wants you to hear. Goldman will, send out a message like, they can, right, leak it out. Like, Goldman says that there's, dollar selling into month end, and everybody's been buying dollars, into this month end, for probably this entire week. And then we've seen this reversal today. But remember, they want you to hear what they want to hear. And if they haven't gotten all their dollar flows that they want, they might send a counter message out just to get the market pushed into their bids, right? So that is one thing that I like to point that out, because we're all at this stage in the game, at least for the most part, and I throw myself in the same bucket. We are retail, and for the most part, and the information you get is not by chance, and it's not because you're special. When we get information fed to us, it usually comes to us for a reason, and it makes its way down to us, myself included, for a reason. So I want you guys just to think about that, especially when you get this messaging from, Goldman, or any bank for that matter. But Goldman is one of those that I really get very skeptical about. So I just wanted to say that, and I'd love to hear what your guys' comments are.
No, the thing is about I would differentiate end of month information and the rest when they're sending out stuff, like those special bulletins or something. The thing which happened is like we know that several banks model end of month flows based on equities, based on bond markets, and based on now what appears based as well on flows that have already been happening to hedge these kind of moves.
Correct. So like all week. I mean, obviously
what we saw over the past months is that Citibank was sending out those models, and they were very right until the day before last. So Citibank was right until yesterday, but then, as other banks were also saying, but we think most has already been done. And then Goldman has been coming out since, when was it, half last year or late last year, with some of those counter calls which have been bang on the last day of the month. So instead of saying this is what is going to happen, we give the information that is out there. But they have been more right than Citibank on the last day of the month. That's what I would say about it. For the rest, it's bags of salt and guessing what's going on.
It is, and I actually put a lot of credence into what you're saying, especially with what we've seen for the last. I mean, look at the dollar index since last week. I mean, obviously the dollar index has been on a rampage, but just take into account starting last week and going into this week, we all knew very well, telegraphed, that the dollar is going to be, bought into month end. And you're right, so much has happened that, there might be some reversal of flows at the end of the week. But, I think everybody just needs to take it a little bit with a grain of salt, everything you get out there, and trade what you see. And one of the things that I'm going to point out today, technically, I'm going to just point this out technically for a few things so you guys can just see what I'm seeing here. We are holding above the spike highs from the COVID spike highs, right? We rallied above it. We've come down to it. And remember, we got rejected at 104, which 103.80 was the 2017 highs in the dollar index. And that RSI, you'll notice here, it actually is higher than the previous one. So what that means is, Dale would tell you, it's a confirmed high. And that means that also we rallied into new highs on strength, and that's usually not a bearish thing. Okay, so before you go out and you get all bearish the dollar and you start thinking, oh, the dollar is going to collapse from here, and this is it, this is the last hoo-yah, be real careful. Be real careful. And remember, we are only one headline away from having a dollar liquidity issue, and the dollar could rally. So you got to be real careful here. Also, I need to point out, since we were talking about the dollar, I want to also talk about what's happening with Amazon. Amazon's ugly. The stock. Did you guys see where we're going to open this morning? You know, pre-market trading at 2,600. Look at all the support that's cracked right now. You know what I mean? And that's ugly. What's Apple going to open at today? I didn't even check pre-market this morning. Anybody do that?
Apple was lower yesterday too. After earnings,
we're down just a couple of bucks. So I mean, but Apple was gapping higher late in the day. I didn't stick around and listen to like the earnings call or anything like that. But you know, Apple's obviously a big component of all this as well. But we've got Amazon that's going to be pretty weak. We'll see how Apple reacts here. But a lot of big support levels are looming for these tech names, and so it's going to be very interesting to watch the market reaction today as we go into month end as well. So
I think we'll take out your neckline, Blake, on the S&Ps with this happening.
I don't think so. I don't think so. Oh, here, let me pull up that chart. Here's the S&P chart that we're talking about. I don't think so. I think we're going to still continue to hold it. Now, again, I am a little skeptical here because it is month end, so anything can happen. But I wouldn't be surprised if we're just bouncing around 4,300 to 4,100 until we get to the Fed, right? Because really that's our next big hurdle of the market is how's the market going to absorb higher rates? Are we going to get the half basis rate hike
oh yeah, they'll do that.
Yeah, I mean, that and how are we going to absorb that? How's the market going to take it? That's all the things that we're going to have to be dealing with. But I don't think that the market's going to get too far away from us at this point. But hell, what do I know? I mean,
Plenty.
Well, I don't know. I mean, when you're at these key levels of support, Dale, you make some great points with there's a lot of bears out there, but for good reason. I say for good reason because let's just take a step back for a moment. The market has been supported by the Fed for the last 12, 13 years. Do they have your back, Dale, right now?
No,
I don't think
they'd like to see a lower market. Orderly, but lower.
I think they have to do what they have to do. I mean, what do you guys think about where equities are at? And I'm just talking about the S&P, guys. We can, you can dive, deep dive into any index you want. But Ryan, what do you think about the markets here?
I'd say just looking on how it performed yesterday after that GDP number. I mean, everyone was expecting a higher GDP number for Q1 because they didn't think that any of the problems had hit in this early, and it was a bit of a disaster, wasn't it? So what's that going to make Q2 look like?
Yeah,
when everyone's expecting it to be lower,
What is it? 2 or 3 quarters in a row defining?
I was just going to ask: is it a technical recession when it's 2 quarters in a row in the US? Yeah,
yes, so 2 quarters in a row. Negative growth is a recession.
But we'll all expect the Fed to brush it under the carpet as not a real recession. Of course.
Yeah. As initially, inflation was not really inflation; it was very transitory, right?
Recession is not really a recession.
Yeah.
What if they decide to pause? They're not at the neck. They raised 50, and then they say they're going to pause and see what effect.
If they give up,
tightening.
If they give up so early,
yes, I know.
If they give up so early, expect things like gold to. Like literally fly like a rocket.
That would turn the dollar.
Oh yeah. Oh yeah. Massively.
Down at 90s or something.
Okay. So all right, just a thought.
Yeah. So
but I don't think they will pivot so fast.
No.
Okay.
All right. So I wanted to ask you guys, Steve, and good morning, by the way, since you're here. So CPI data out of the Eurozone, what do you make of it?
It's catching up, and it's doing so very, very fast to what we've seen in the US. And the problem is that oppositely from the Fed, that due to political reasons, due to upcoming elections, due to the issue getting out of hand faster, at least the Fed is showing some intention to do something. I've explained multiple times why it's not going to be sufficient, but in any case, they are moving somewhat in the right direction. For the time being, the ECB is just seems to be completely ignoring that there is even a problem, which is
that's a problem in itself.
That's a huge problem in itself. I mean, I don't know what to say. We're talking about.
Hey, Steve, let me just, since you live in Greece, all right, let's talk this out for a second. And how big of an issue is this? All right, so you're
huge.
Well, wait, hold on. Just let me finish my thought here. You're the ECB. You got inflationary pressures, obviously. The weaker euro is not helping the situation. So you really need actually a stronger euro. But on the other hand, you're the ECB and you're thinking about Italy, you're thinking about Greece, you're thinking about Spain, Portugal, and you're thinking, holy crap, we're going into summer, and we got growth is already, we're seeing the signs of it slowing already. Do we really, start getting really hawkish, fighting inflation?
Yeah,
euro rallies, and it takes away from tourists.
Yeah, I have an answer for you. First of all, we've seen that income from tourism doesn't really get that much affected from the price of euro. We've had wonderful.
Wait, we just you and I just priced tickets between Greece and the United States. And I'm going to look at the.
You're going to look at the exchange rate, but believe it or not, the basic factor is how people are doing. I mean, if you're going to end up paying a little bit more due to the exchange rate, yes, people take it into consideration. Although keep in mind that having to do with tourism, the vast majority of the income you make from tourists is not from the person that's going to come on an extremely tight budget.
Yeah, that's true.
Exactly.
And Dominic says it's going to be mostly Europeans as well. I mean,
yes. So a lot of tourism from Europe, plus the people that come from, far away, usually are the people that are not that much price sensitive, right?
Right.
Because, for example, let me give you an example that a lot of people that know Greek tourism know, right? And no offense, Ryan, by the way, Jane or Amanda. There are specific areas.
Don't leave out Cayman.
No, Cayman is not British. That's why I'm going to say it. So there are specific areas in some islands in Greece that are dominated by cheap British tourism, right? Specific areas. There is a place in Rhodes. There is a place.
What's their phone number?
Yeah,
I'll get you a brochure, Dale.
So
I'd love it.
these people, for example, and it's just one example, right? These people go in specific hotels that are all inclusive, very cheap, and they spend practically nothing outside of their all inclusive hotel, right? For these people, for example, even if some of them don't come due to the exchange rate, you don't really lose that much having to do with income from tourists.
Yeah.
So other people, on the other hand, somebody that wants to travel from Los Angeles, right? A rich tourist that wants to travel from Los Angeles and have his luxurious vacations in Greece, they won't really mind if the Euro USD is 3% lower or 3% higher.
Yeah.
And these are the people.
And I agree with you. Really, I'm just kind of throwing it out there. Like, is that even a factor? But we got to be kind of quick here, Steve. The reason why was we got data coming
out. Now, having to do with what you said with Spain and all the rest of the countries. Let me
think about the ECB. What's the issue? What's the hang-up? Why can't they? Did you see the Spanish?
Spain is a country that has industrial production. They're producing, for example, for Volkswagen, the SEAT cars, right, etc. So it is a country that, other than tourism, they also have like industry, right? Did you see the PPI number for Spain?
The PPI, no, I missed it.
Yeah,
it was 50, wasn't it?
It was close to 50% year on year. Can you put that number in context in your mind? Can you imagine that the companies need to spend 50% more for their input of production within a single year.
Right,
People are calling that top in inflation.
Steve, we because we've seen it almost across the board, but why can't the ECB raise rates? Tell me that.
Because the Eurozone is full of zombie companies and zombie banks and over indebted countries. But in my opinion, it's still the wrong decision, because at the end, nobody will be able to save those in the long run. The question is, what else is going to get destroyed by this reckless monetary policy until there is no alternative, right?
Yeah, well, it's going to be really interesting. I think you should stick around for the Fed guy when he gets here. He is going to be, Joseph Wang. He's really interesting. He's on Real Vision. I've been wanting to meet him forever, so I'm happy that Dale has him here. So he's going to be awesome. You should stick around, Steve, because I think it'll be a very interesting conversation. Hey,
somebody's asking about what do we mean by Fed guy. Do you want to say a couple of words, Dale, about your guest?
That his name's Joseph Wang, but that's his. He worked at the Federal Reserve, right?
Yes,
right,
Dale. Anyhow, we have a guest that works for several years for the Federal Reserve, so he's going to give us a very good.
Yeah. Anyway, I'm sure Dale's like stepped away for a second, but
I'm here. I'm here now.
He's here. Okay. We're just asking who Fed guy was, but Joseph
Wang.
Yeah. He's worked for the Federal Reserve. Like I said, he's done a lot of recently. He's done a lot of talks on Real Vision, which is funny. I've been following him around a while on Twitter, and I'm like, man, I got to ask that guy on to. And I never saw him on Real Vision or anything like that. And all of a sudden, he started popping up on Real Vision. I'm like, damn it, they beat me to the punch. Anyway, they beat us to the punch. Let's real quick. We only have just a couple of minutes. We saw stocks are, kind of where they're at. We got month end coming in. Let me ask K-Man, if you're still here, look at that dollar yen. We're seeing a pullback today. We still, technically we have, a pennant formation that points to 135. Do you think we're going to do, let me ask you this really quick. Do you think we'll see 126 or 135 first? So are we going to see?
You have those questions. 135.
135 or 126? You think 135?
135.
I agree with you. Okay. Anybody else have an opinion there?
I think
why 126? Why 126? I think if it all depends on the Ministry of Finance, right? I mean, if they intervene, it can be 121. But if they stay away, it's gonna be 135, 140.
Well,
we had to look
the difference between the euro at 90 cents and the euro at 110 is really Putin, right? So, I mean,
no, it's also the big gap between projected monetary policy. It's a combination of the two, actually.
Yeah. Anyway, but all right, K-Man, that's a great opinion there. I think so too. I think you have to still buy dips in the dollar yen while you get them. Like this dip should be bought. And we're seeing the dollar actually kind of firm up here. Any other like last minute thoughts before this PCE data comes out, guys, gals?
Yeah, just watch the clock. Watch the clock, especially until 4 p.m. London time.
4 p.m. London time. Thank you very much. And I said gals because I was referring to Ryan. So and his West Hampton team. Sorry, buddy. Just kidding. Hey, Ryan, any last minute thoughts before PCE?
No, just another thing just to keep an eye on. We've got a fairly large expiry, over 2 billion expiring in euro dollar at 105.60.70. I mentioned earlier today we might see the price sort of gyrating about 30-40 pips above below that area, and that's what it's doing at the moment. So just keep an eye there.
Okay, and I know all you attack people are going to be like, oh, here we are, euro's holding 105. Now we have an inverted head and shoulder pattern developing, and blah 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 blah. But flows don't care about what your technical patterns say. So just keep that in mind as we go. This is a big one. We've had a big move. We've seen equities come off. We've seen the dollar really rally. We've already seen a big move. So to be honest, I don't know what to expect. I don't have any dollar exposure. So I'm just, I'm kind of freewheeling it today. And I don't feel like getting run over by a freight train by the end of by today for any, silly reason. So I'm gonna pull up data flash here. This is included with Forex Analytics. This will give you. Why don't I see Canadian GDP that just came out? Crap. Where did the producer prices? Somebody yell at me what we see here. Anybody? Bueller? If it comes out, just hit me up because I don't.
It's not out yet.
Flash.
It's not out yet, mate.
Thank you. I don't know why it's not on there, which is weird. Did you see that, Steve?
February, Canada GDP a little bit better.
Okay, and the dollar CAD is dipping. We are seeing the euro pop up a little bit. Dollar yen is moving here. 1.1, Mike says.
6.6% PCE year on year. That's up 2 points.
Employment cost index 1.4%.
Core is 5.2% versus 5.3% expected. Prior 5.4%, so that's dipped 2 pips.
Okay, those are pretty healthy numbers for data. So we are seeing the dollar firm up a little bit here, continuing into month end, which is going to be really interesting going into as K-Man said, 4 p.m. London time. As a dealer, K-Man, do you miss the fixes? He might have disappeared. I think he probably disappeared because he jumps into the Forex Analytics chat room. So hey, just real quick, guys, this is the Forex Analytics chat room. Speaking of which, you want to see how busy our community is. Remember, we don't talk politics, we don't talk religion, we just talk trades and sometimes the occasional Netflix show if nothing else is happening in the markets. This is just from when I got up this morning. This is Friday and it's slow. So this is where I popped in about an hour ago. Right there. Good morning and TGIF, everyone. This is just the general chat room, and you can see it's really quite busy. And that's macro chat room, trades room, news room, Spanish chat room, and you get all that with Forex Analytics. So check it out. It's $1 for 10 days to get this platform and to get inside of our community. Check it out, and then also check out the Trader Funding Program. I was just actually talking to a broker last night about, prop trading and how I view it. And we were talking about cryptos and so many of these altcoins have just, gotten decimated. And I was explaining to him that, being a student of the market in the 90s, I was greatly influenced by what happened in the tech bubble. And I got destroyed in the tech bubble like a lot of young traders did. And I said, post 2000, if I would have had the opportunity to be able to access, larger trading accounts because I knew how to trade, I would have wanted that. And so that's kind of where we're at with the Trader Funding Program. So if you're interested in it, check it out. Watch the video at the very end. Dale,
do me a favor and promote Joseph Wang for me. My internet was unstable.
Were you trying to do it? Oh, okay, that's where you were probably at. Let me see if I can do that right now.
He's
waiting for you to chime in. So
attendees.
Okay, I'm going
under his name.
Doing it.
Thank you, buddy.
I don't know my ABCs, so just bear with me. I wheel mouse the other direction. Sorry.
First name Joseph.
Yes.
JOS.
He's here. So you guys stick around. This is going to be a great interview. I'm very excited to meet Mr. Wang. Let's see if he is here with us now. And
he is a panelist now.
He is. And let's ask him to unmute.
Hello, can you hear me?
We got you, Joseph.
Hey, thanks so much for inviting me. It's a pleasure.
Before we get started, Joseph, I want to introduce you to the founder for it.
I think we just lost Dale. Dale? Or did you just lose Blake?
No, I think Dale's dipped.
No, Dale is gone. He said he has internet issues.
Joseph?
Yes.
Nice to meet you. My name is Blake Morrow, and we have the Forex Analytics team is here. Steve, Ryan Littlestone, Steve Vulgaris, and Dale is hopefully he's here. If not, we're all here. So welcome to to the F.A.C.E webinar, and I'm going to play interim host right now while we're waiting for Dale to come back. It sounds like he is having some internet issues. So thank you for joining us. I was just telling our audience and the traders that are here on a daily basis, I was telling them how I've been following you on Twitter for a while, and
I'm back.
I'm like, man, I think you're probably one of the smartest guys that I've seen on Twitter. I love your commentary, and I'm like, we got to invite him on to the F.A.C.E webinar, and then all of a sudden, Real Vision, started asking you on. I'm like, dang it, they beat us to the punch. So it's so nice to have you here. Can you tell like the traders that are listening in, a little bit about yourself and your background?
Sure. Well, first of all, thank you for inviting me, Blake. I really appreciate it, and thank you for your kind words. So I used to be a senior trader on the open markets desk, and that is the trading desk for the Fed. So what I did there was run operations. So I was a repo trader, but what you really do on the desk is you study the financial system. So you're kind of like a strategist. So what I did there was just study the banking system, the financial system, and how things all fit together. And in my view, that's a really useful way to understand the markets, especially now when so much is macro driven, particularly by central banks. And looking at some of the charts you guys here, it seems like a lot of the work you do is in currencies. So that's kind of exactly, in my view at least, one of the major drivers in currencies these past months is central bank interest rate differentials. So I think that is a useful way of understanding markets, especially the FX market. And before I was at the Fed, I was a credit analyst, and before that, I actually was an attorney. So I practiced law for a little bit, but it wasn't for me.
It's that's actually a pretty awesome, scary, and dangerous combination, I would say. Now, when you're talking about interest rate differentials, I try to explain to traders, and yeah, we do focus a lot on currencies, but we actually talk a lot about macro and what's the drivers behind the market, because I think what traders really get hung up on, and especially we deal with a lot of retail traders that are some of them have been trading around the markets for decades, others are just kind of dabbling into the markets. I think what we find is a lot of people put so much emphasis on technical analysis, but they don't put enough emphasis on the macro point of view, having the thesis, having that tailwind in your back, if you will, while you're trading the markets and trying to make some money, understanding the what is the movers. So when you talk about interest rate differentials, that's what we've always looked at as the biggest mover in the currency market. So what is for you right now? We're seeing this big divergence between what's happening with the Fed and where other central banks are playing catch up, and you have the ECB, which really is almost like non-existent at this point. What are your views as far as interest rates where they're at right now and where they're going, and is the Fed really going to follow through with what they've been warning us, especially now over the last few months? What do you think?
Yeah, these are really good questions. First, I would say that looking at the interest rate markets broadly in the past couple of months, I think it's largely driven by policy differences. Now, for FX, as you guys know, momentum and things like technicals play a role, but I think this move largely is driven by policy changes. And the most obvious candidate for that is, of course, the Bank of Japan's yen. That yen move against the dollar, it's like a parabolic move, and it looks like it's going to continue as well.
Yeah.
So what's happening, in my view, in the FX markets are twofold. One is political and the other is CB driven. The political aspect has to do with the fact that it seems that there's a prospect of a continuing war in the Eurozone. So if you look at what the administration is doing, they're not really seeking to de-escalate. They're not really fighting ways for, let's say, Russia to back off, giving them a place to stand off. They're giving Ukraine lots of weapons. They seem to, and I think various administration officials have hinted at this, it's a way to weaken Russia. And so if that's the case, it's going to be a protracted conflict with potential of escalation. And if you have capital in Europe, then there's a very serious risk there. And so there's a lot of capital moving out of Europe into dollars. And so I think there's that one move there. And moving on to the second point, central bank differentials. It's obvious in Eurozone, like Europe is, so they're thinking of hiking rates. but the Fed is hiking much more aggressively. There's that thing there. So that's going to play a role. But the biggest interest rate differentials are between Japan and the US. So stepping back, the global bond markets are highly correlated with each other. Bonds are not so much like equities. In equities, when you can have moves in, let's say, in China, for example, equities can keep falling, but in the US, equities can keep going up. They're not as interrelated, but the bond markets are, because they're viewed as globally as safe credit risk-free assets, they're highly correlated. So usually when you have bond yields moving up in the US and the Eurozone, you would expect bonds throughout the world to move up as they have been doing. Now, it would be natural for JGBs, so bonds in Japan, to also move up in tandem with the US, but they're being prevented from moving up. The Bank of Japan has a policy called yield curve control, where they're basically putting a ceiling on the 10-year JGB at 25 basis points. And whenever the Japanese bond market wants to sell off, that's to say yields go higher, you have the Bank of Japan in there basically having an unlimited bid. And if the markets can't adjust through interest rates, they have to adjust through foreign exchange. So what that means is, at the margins, someone somewhere in Japan, rather than accepting, let's say, 25 basis points in their JGBs, they're moving their money outside to the treasuries, or even to, let's say, French oats or Italian BTPs, things like that. And that has a negative effect on the currency. Now, what you want to keep in mind, though, is that the central bankers, they're aware of this, and there's something that they have control over, and they're permitting. It's part of their goal. So Japan, if you listen to their meeting, I think yesterday, what they're concerned about their inflation. Their inflation is too low. It's going higher because of energy, but they think that's temporary. So in order to have sustainable, let's say, inflation around 2%, they're usually below 1%. They want to be able to continue to maintain an easy policy. And part of that, of course, is trying to import inflation via weaker currencies. So it's part of their plan to do this. So when you have these interest rate differentials and you have the blessing of the central bankers, it's kind of a one-way trade. And so you just kind of go higher.
Yeah, I was going to ask you, I mean, were you surprised? I mean, because we've seen such an outsized move in the yen just over the course of the last, obviously over the last month or 2 months or whatever it is. Are you surprised that, the Bank of Japan is still is not worried about the yen, and you haven't heard anything from the Ministry of Finance? I mean, is that surprising to you, or do you kind of fall in line with the BOJ and say, I agree that they're not getting enough, they need more inflation, which I think is crazy, but anyway, but that's me personally. I was asking your opinion. What do you think?
Yeah. Oh, first of all, I just follow up on your last question. So whether the Fed will actually carry through the hikes. So that's actually not that important, because when the Fed says they're going to hike, it gets priced into the market immediately. So it's already there. Now, they may not actually realize, so the market is pricing in, let's say, 2.5 inch overnight rates by December. They might not actually get there, but it doesn't really matter, because once saying that, it's priced into the market. So if you want to go and you actually have to borrow at let's say, in the 2-year level, that's the price you pay. Those are the rates that you pay. So it's already happened. Whether or not they actually carry through, that would just change future pricing. So,
hi, Joseph. I'm Dale Pinkert. Nice to meet you.
Hey,
I'm
Dale.
having some internet issues, but you write about the great steepening. I went over that your website, but the burning question for me and a million traders out there, is there really a plunge protection team, and were you on it?
I was on the plunge protection team, what you would call that, but our mandate was not to save the stock market.
All right.
But who knows, man? Maybe Jay Powell has his own private Bloomberg terminal that he's just banging on it whenever something goes. But as far as I'm concerned, it was not done through the trading desk. So as far as I'm concerned.
All right. So then why don't we get?
So wait.
So you didn't answer it.
He does have a bat phone somewhere.
All right. Well, everyone, plunge protection team. Now I think they have a bear. They have they talked about a Fed put. Now, do we have a Fed call? And the Fed wants this break to happen in the market.
Yeah, I think they do. It's actually something that. So last week, Jay Powell was on a panel at the IMF, And the journalist actually asked him, so are you trying to get equity prices lower? And, he just kind of danced around it. So the way the Fed thinks about this is that when you have, let's say, a really hot market like you do today, hot as in real economy, inflation hot, what you want to do, the textbook answer, is to tighten financial conditions, right? So you want to slow the economy down. What are financial conditions? The way the Fed looks at it, there are a lot of different components to this, things like spreads, level of interest rates, things like that. But one of them is equities. So when you're hiking rates and you see equities still buoyant, that tells them that financial conditions aren't really tight yet. And if they're not really tight, then you kind of can't get to your goal of, slowing down the economy to fight inflation. So having lower equities is definitely expected. And I would actually go further and actually highlight something else that I think is developing in the central banking world. So the Bank of England, one of their senior policymakers there, had a speech, I think just a couple of weeks ago. And what she mentioned was that one of the things that she's noticing is that, hiking rates doesn't seem as effective as it used to be, maybe because central banks have very large balance sheets. So there's so much liquidity in the system, maybe hiking rates is not as effective as it used to be. And if that's the case, maybe we have to hike more aggressively. And I think that's what's happening in the central banking world, because you see that in the Bank of England, but you also see that in the Fed as well, right? So suddenly we went from last year, I don't think we're going to hike rates, to now we're thinking, yeah, we're going to do it 50 basis points multiple times, right? So that's kind of going to be the playbook. We're going to have to hike aggressively, in part because they want the asset prices to go lower. And
why not match sales, Joseph? That used to be a tool for draining. Are they going to be using that tool?
So you're like shifting like an operation twist, that you would basically change the yield curve level. Let's say the shape of the yield curve, you mean?
Yeah.
Like maybe sell the front end, buy the long end. Well, yeah. I think the problem is it's just that everything is just too low. That's the issue. Okay. Yeah. But so that everything is too low, and the Fed has, if you listen to them, they don't really feel comfortable having such a large balance sheet, having so much treasuries on their portfolio. They don't feel comfortable about this because they actually don't know how it works. And you can read many senior FRB presidents talk about this. They don't really understand how QE works or QT works, and so they don't feel comfortable doing it. And so they feel like they would like to be in a world where they use something that they understand, that they feel comfortable with, and that's the Fed funds rate. And so part of it is trying to get a smaller balance sheet.
Okay.
But also, I don't want to leave Blake's earlier question just hanging there. So about the Bank of Japan, whether or not they think that they're going to, if it's, I think I was very surprised that they let this parabolic yen move go higher.
Yeah.
And it's strange because they have so much opportunity to push back on this, but it seems like they're okay with this. And I don't know what Kuroda has as his target internally. I'm sure. So the way that they do things, they definitely have a target. Just don't know what it is. What's more important to them, I think, is that it's not disorderly. So they don't want to go from 130 to 150 in a week, but whatever their target is, they want to get there in an orderly fashion. What I
we're going from 115 to 130 in
0 time
is okay.
Yeah. I mean, that's just. I mean, you don't really see moves like this, right? So it's just amazing. But one thing you want to keep in mind, though, is there is tremendous fragility in this trade. So one day, and I don't know when, maybe it's 140, maybe it's 150. One day they're going to feel like this is enough. We've got the yen to where we want to be. And when that happens, they're going to have to, stop this depreciation. The easiest way to do this is going to be to relax yield curve control. Right now, that's a 25 basis point ceiling. When they let it go, there's a potential for it to be tremendously disorderly. So the Reserve Bank of Australia also used yield curve control under 3-year during COVID. And they let it go last November, and it's kind of a mess. There's no easy way to let things like this go, and so it has the potential to be volatile, But two, as I was mentioning earlier, you have global yields that are all closely connected. So if you have the 10-year JGB, let's say, go up 25 basis points suddenly, or maybe more, that's going to very quickly flow through to treasuries and the rest of the global yield curve. And so that's some potential for volatility in rates across the world. And I mean, what do you think would happen to stocks or other risk assets if woke up one day and 10 years suddenly up 20 basis points? It's a volatile thing. So I don't know when that will happen. I just imagine that one day the market is going to take the yen and carry it too far, and then the BOJ will step in and put a stop to it.
Joseph, this is Steve Vulgaridis. Based on the multiple things you've told us already, I have a very basic question, and it is the following. You used to work for the Fed for several years, so you don't only have the view of the outsider, as we all do, but you also have the view of the insider.
Yep.
Do you think that these institutions, with the role they have taken for themselves / given to them by politicians that don't want to face expedited issues that have to do with the economy, are nowadays, with their current role, I reiterate, useful? Do they bring more good on the table having to do with guiding the global economy, or they actually do more harm in the long run?
I think they do more harm in the long run, and it's for exactly the reason that you mentioned. So these guys, listen, the government is going to be short-sighted, right? So they're going to do things that help them now. And I think the biggest problem that I think central banks caused is that they made it easy for governments to engage in deficit spending that is just out of control.
Profligate, yeah.
Exactly.
They subsidized it.
Subsidized it enormously. I mean, so the Fed has $5 trillion in treasuries on their balance sheet, right? And so the US Treasury looks at this and be like, hey, we can just spend infinitely, and it's no problem because the interest rates are low. And that leads to a lot of distortions in the economy, where you have, first of all, you have tremendous spending to, let's say, special interest groups and things that are not good for the public, but good for the politicians. But you also get the public addicted to free money because they think that they can just issue this debt and spend forever. Now, that would not be the case if the Fed was not there to subsidize them, right? Sooner or later, they would be rates would be higher, and there'd be more inflation. So I think it distorted the incentives. So
what do you think can actually bring an end to this era? I mean, and is there any way for this to happen in an orderly fashion?
So for things to be unwound orderly, I think so. The way that I view things is that it's not so much the Fed is complicit, but the biggest driver of things like, let's say, inflation or potential disorder is what's happening on the federal level, because you're basically printing treasuries and buying goods and services at an unsustainable rate, right? And the only way to stop that is if you raise taxes, let's say reduce deficit spending, live within your means, so to speak, for a little bit. And that's just really hard to do in a world where you have periodic election cycles. So if you listen to what the Biden administration is talking about, they want to forgive everyone's student loans, right? That's like over $1 trillion of free money that's going to be put into the economy. It's going to be highly inflationary. You can think of it as a tax cut to everyone who borrowed student loans, because now they don't have to make that student loan payment anymore. They have more disposable income. So you have incentives like that, and it's hard to ever stop it, because thus far there have been no consequences. But it looks like consequences are appearing in the form of higher inflation. So I don't think there's an orderly way to do this.
I also have a weird question, which doesn't directly involve you, but being in the Fed, I always had a big question mark in my mind. Are journalists complicit to this? I know it's a weird question, but I'm gonna explain what I mean. I have watched several press conferences, right? And it makes you curious. Where do these people come from? I mean, they almost never ask the obvious, difficult questions. Are they vetted before they get there?
So I'm not familiar enough with that process to know if they're vetted. But I will say this one thing though. So I know some journalists, and the way that if you are a journalist and you want to have good stories and be close to the Fed, you have to have a relationship with them, right? You have to be friends with them. Now, if you're asking things that are critical with them, then you're not going to get access. So there's an incentive there to say good things and be and play along. But another thing that I would note is that occasionally, when I was at the Fed, we do read stories from journalists that we think are really weird and not fair and just nonsensical. So there's that too. So it's not super clear to me. I'm sure some journalists are just playing along as mouthpieces for the Fed, but not all of them.
Okay, Blake.
Yeah, that's an interesting question. But Joseph, I say your insights are awesome, and thank you so much for just taking the time and spending it with our community. Just helping us understand, what really happens at the Fed and kind of some of the moving parts that we all deal with as traders. So I want to ask you just a couple of questions as we wrap up. Do you think, and I want to kind of go back to the original question about Fed raising rates. Do you think that the Fed is anywhere near like their forecast? Do you think they're overshooting right now, or do you think rates are actually going to continue higher for some time? What are your thoughts from where expectations are now to where you think reality might be moving forward?
I think that the front to medium term is priced well. So I think the market right now is thinking that the Fed would probably go to a terminal rate of a bit over 3%. That, at least for now, I think that's fine. What I think that the market is not pricing as well is the longer dated rates. Let's say 10-year are just below 3%. That doesn't seem right to me. So I guess I'd give you a bit of background. So I don't know. Everyone comes from a different background. So, and
Sure.
Some of you may know this, but the way that let's say the 2 to 5 year is priced, it's just basically priced completely off anticipation of Fed actions. And the way that this is enforced is that the knowledge that the Fed has complete control over the overnight rate. So, for example, if the Fed says the overnight rate, I'm going to have it to be 1% from here today until the next 3 years, then if you are someone who is lending in the markets, you can say, well, I can lend overnight to the Fed every day at 1%, or I can lend someone for a 3-year term, right? But the two have to be comparable. So 3-year rates, term rates become 1% because I can either just lend to the Fed every day overnight, or I can lend for 3 years and get the same price. So the market's understanding of one, the Fed has very strong control over the overnight rates, and two, how they will guide the overnight rates for the next 5 years. It's more easy to anticipate, and so you can have whatever is between 1 to 5 year as very, very much as what the Fed market thinks the Fed would do, and I think what they're anticipating is probably right. Now, beyond that, let's say 5 to 30 year, it's a lot harder for the market to know what the Fed will be doing in, let's say, 10 years, because really, right, who knows, right? So a lot of that really just comes down to supply and demand. I think that the market is mispricing, let's say, 10 years, 10, 20, 30s, because we're going to have a lot of supply in that market coming online. And if you look at the trajectory of how the government conducts its spending, it just kind of spends and borrows, right? So it basically issues more debt at a very high rate, and it looks like it'll do that forever. So there's going to be a lot more supply coming online, and I suspect then that the market rates will have to go higher to find more people to buy that. So I think that's probably mispriced in my view. So I think that there's a lot of reasons for this. I mean, if you were like a central banker, then you would say, oh, the market has low interest rates in the future because they think that central banks are super responsible. And so we have great credibility, inflation will be stable, and voila, Mark, that's why the 2 years at 3%.
Right.
if you ask some, like, let's say some macro people, they'll be like, yeah, because we have aging demographics. So of course growth will be slow. So obviously longer term rates. Yeah, I don't really believe any of that stuff because I think what happens oftentimes is price leads sentiment, right? So you have a 3-year, 10-year yield at, let's say, a bit below 3%, and people make up stories to justify. You see that in equity markets all the time. I think it's just some mispricing. With respect to those former two arguments, I mean, inflation is not really all up to the Fed, to be honest. It used to be so when you have a world, let's say 100 years ago, where everything is private. Now, I say that because private sector is interest rate sensitive. So if you're the Fed and you raise rates, then obviously all the private sector borrowers, people who have actual businesses, they react to that. Maybe they cut down their economic activity a bit so that inflation gets under control. But we're moving into a world where the government plays a very, very large role in the economy. And the government is not sensitive to interest rates. They just don't care. So, rates could be like 10% and Congress would not care, what they want to do. They just borrow and spend, right? So if you're living...
sorry to interrupt, Joseph, but is that indeed the case? Meaning, for example, with the debt maturity of the US being having a durability of average duration of, what is it, 3, 4, 5 years, something like that. Isn't it going to start biting very, very much once they start having to roll over all that debt with 5%, 6%, 7%, because it's going to be making the need to borrow a lot bigger, a lot faster? Isn't that going to become a political issue at some point?
It could be, and I hope it does. But it's so far, just looking for the past few years, it just doesn't seem that way, right? So,
yeah, but the past few years, we did still have super low interest rates. Now we seem to be changing from that, right?
So there used to be a culture where there would be one party saying that we got to shrink the government, have small spending. I don't get the sense that people care about that anymore, and you even have some part of the economic world would advocate something like MMT, saying it doesn't matter. And you have President Biden basically saying, yeah, well, if we have inflation, we shouldn't cut back on spending. What we should do is we should spend more and increase the supply. So I hope you're right that we do have, let's say, some cultural change such that becomes more concerned about the spending, but I don't see it yet, and it seems to me that
I think it's going to be forced upon government sooner rather than later. Reality is going to be harsh.
The reality only manifests itself in inflation. It will never manifest itself in rates because the central bank can always buy it all and let's say peg the yield curve if they want.
Yeah, I was just gonna go there okay, but anyway. That's it. Gosh, Joseph, I know you've been really lenient with your time, and I want to say I appreciate having you here. I'd love to actually do a deep dive on some of these topics on Traders Summit if you're available sometime.
Sure. I mean, I'm happy to speak with you all, and thank you very much for inviting me. I enjoyed meeting all of you.
Yeah, thank you, Joseph. And
Dale's still here. Okay.
Yeah, and for people that were watching or watch a video later, you could follow Joseph at FedGuy12, and Joseph has a great website, fedguy.com, and great to have you as part of our intelligence gathering here in